A number you never chose is deciding whether you eat well or eat poorly for the next 30 years. Most people find out what that number is only after it has already done its damage. In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac sat in a small office in San Jose, California. They had an idea. They believed human financial behavior could be predicted, not guessed, predicted, like weather, like physics. They called their company Fair, Isaac and Company. The world would eventually call their invention the FICO score. Nobody paid attention for decades. Banks were still doing it the old way. A loan officer would sit across a desk from you. He would look at your face, your clothes, your handshake. He would decide in his gut whether you were trustworthy. The system was deeply personal. It was also deeply unfair. Women were denied loans because they were women. Black families were denied mortgages because of the neighborhood they lived in. The decisions were human. So were the biases. Then the credit card industry exploded in the 1980s. Suddenly, banks needed to approve thousands of strangers every single day. There was no time for handshakes. They needed a machine. They needed a number. Fair Isaac had one. Here is how the number is built. Every time money moves through your life in a formal way, it gets recorded. A credit card payment, a missed bill, a new loan application. 3 private companies, Equifax, Experian, and TransUnion, collect all of it. They are not government agencies, they are corporations. They collect this data because it is valuable. Then they sell it. From that data, a score is calculated. 300 at the bottom, 850 at the top. The exact formula is a trade secret. Fair Isaac has never published it in full. The inputs are known, the precise weights are not. Payment history matters most, about 35% of the score. Pay late, the number drops. Pay on time, it holds. Simple enough. But the second factor is where it gets strange. Credit utilization. How much of your available credit are you using at any given moment? This counts for roughly 30%. The system rewards people who have large amounts of credit available but use very little of it. In other words, the score rewards having access to money you do not need. If someone has a $10,000 credit limit and uses $200 of it, the score rises. If someone has a $500 limit and needs to use $400 of it, the score falls. The system is not measuring discipline, it is measuring proximity to wealth. There is a woman, call her Sandra. She grew up in a household when nobody had a credit card. Her parents paid cash for everything. They believed in it. Debt was something to be avoided. Sandra was raised to be careful. She graduated at 22, got a job, rented an apartment, paid her rent on time every single month for 4 years. None of it counted. Rent payments at the time were not reported to the credit bureaus. Her discipline was invisible to the machine. When Sandra tried to buy a car at 26, she sat across from a loan officer who looked at her file and said, "You don't really have a credit history." She had been financially responsible for 4 years. The machine had not been watching. The only way to build a credit history, she was told, was to take on debt, to borrow money she did not need, and then pay it back slowly. "So I have to go into debt to prove I'm good with money," she said. The loan officer shrugged. That was not his problem. Sandra opened a credit card. She used it for small purchases, groceries, gas. She paid it in full every month. After 18 months, her score had risen enough to qualify for a car loan at a reasonable interest rate. Someone else in her position, who had not figured this out, would have taken the only loan available to them, a subprime loan, a higher interest rate. On a $30,000 car, the difference between a good credit score and a poor one can mean paying $6,000 more over the life of a loan, sometimes more. The low score does not just reflect financial difficulty, it deepens it. The score does not stay in the world of banking anymore. That boundary dissolved quietly over the past 2 decades. Landlords run credit checks before renting apartments. A low score can mean rejection, which means the person must rent in a less desirable area, often at higher rates relative to quality, because those landlords have fewer choices of tenants and can charge premiums for overlooking the number. Insurance companies in most states use credit scores to set premiums. A person with a poor score pays more for car insurance, more for renter's insurance. The reasoning is actuarial. Statistically, lower scores correlate with more claims. Whether the correlation indicates causation or whether the causation runs in the opposite direction, is a question the industry does not spend much time on. Some employers run credit checks before making job offers. This practice is most common in financial services and government roles. But the logic has spread. A person who is struggling financially, who may have a low score because they lost a job, can be denied employment because of the score that reflects the job loss. The loop closes on itself. There are people who have figured out how to play the system with precision. They are called credit hackers or points optimizers. They open multiple credit cards to raise their total available credit, which lowers utilization. They time their payments to hit before statement closing dates so the balance reported to bureaus appears lower than it actually was. They know that certain card issuers report to all 3 bureaus and others report to only 1. These people have scores above 800. They fly business class on points. They get approved for mortgages at rates that will save them $40,000 over 30 years compared to someone 40 points lower. The information to do this is freely available. It has been for years, and yet the gap persists because the people who most need to know it are often the least positioned to act on it. You need existing credit to optimize credit. You need financial stability to perform financial optimization. In 2003, Congress passed the Fair and Accurate Credit Transactions Act. Among other things, it gave every American the right to 1 free credit report per year from each bureau, not a score, a report. The score still cost money to access directly, though banks and credit card companies now often provide it for free as a retention feature. The act also gave people the right to dispute errors, and errors exist in substantial numbers. Studies have found that a meaningful percentage of credit reports contain mistakes significant enough to affect a score. A debt incorrectly attributed, an account reported as delinquent that was paid, a fraudulent account opened in someone's name. The dispute process exists. It is slow. Bureaus have 90 days to investigate. Many disputes are resolved quickly. Others are not. In the meantime, the number sits there, and the doors it controls remain closed. In 2020, a new scoring model was being tested, FICO Score 10T. It introduced trended data, not just a snapshot of where you are, but a moving picture of where you have been. Scores rising over time would benefit. Scores falling, even if still in an acceptable range, would not look as favorable. The same year, some lenders began experimenting with alternative data, rent payment history, utility bills, bank account cash flow. The idea was to capture the Sandras of the world, people with thin credit files who were, in fact, responsible. Progress moved slowly. The infrastructure of the existing system was vast and entrenched. Changing it required the participation of thousands of lenders who had built their entire risk models around the old data. Bill Fair died in 2012. Earl Isaac died in 2023. The company they built is now publicly traded on the New York Stock Exchange. In 2024, its revenue exceeded $1.7 billion. The score they invented is used in 90% of lending decisions in the United States. They set out to remove bias from lending, to replace the gut feeling of a loan officer with something objective, something that could not see your face or your neighborhood. The score cannot see your face. That part worked. But it can see your zip code. It can see your available credit limit, which often correlates with the wealth of the household where you first learned about money. It can see the financial decisions made by a 22-year-old who did not yet understand that the machine was watching, and it will hold those decisions against you for 7 years. The bias did not disappear. It was encoded, and then it was automated.